Bank's annual report for FY25 has showed the balance sheet is up more than 8%. Net income rose 27% on forex gains, while the value of gold holdings rose 57% as the central bank added 54 tons of fresh gold in FY25. Latha joins us now with the fine print. Latha.
Well, the interesting takeaway are all over the place. One of them is that the RBI has bought a lot of gold. They have bought 54.13 tons of gold. So the total value that they hold is up by 57%. From 2.75 lakh crore, it's gone to 4.32 lakh crore. Only, 7% of that has come from the actual amount of gold increase by 54 tons, as I told you. The rest is because gold prices have shot up. You would think that 7% is a very big number, but it's bigger. It's the highest in the last 3 years. Last year, their gold holdings, the amount in tonnage rose by 3.5%. The year before by 4.6%. But way back in FY22, they had bought 65 tons of gold. So at that time, it had gone up by 9.3%. So this is not the highest, but clearly highest in 3 years. The other thing you learn is about why they reported this subdued dividend compared to what the market was expecting. That's entirely because they've increased the reserves, which is why the board met. The board met and said that instead of a contingency reserve of 5.5 to 6.5, they will expand it to 4.5 to 7.5. They've increased the reserves to 7.5. And that means 254 crores more had to be set aside to take the reserves to 7.5%. And if they had not done that, that 76,000 crores would have been added and the surplus could have been 3.6 trillion. But obviously, they probably want to smoothen it out and they could lower the reserves this year, who knows. The other point to note is that they've not made so much money in selling dollars. You know, when the Bimal Jalan committee allowed them to book the dollar profit, the RBI was making some 14-15 rupees every dollar sold because the purchase price was the historical price. But now all that has been juiced out. Today, if you do the math, in FY25, they have earned only about 2.8 rupees per dollar sold. Not a great deal of profit because a lot has already been juiced out. That could be the reason why they wanted to change the reserves and give elbow room in the future. Finally, the most important part of the annual report is the economic outlook. No surprises there, except some extra optimism, more than we were prepared for. The global outlook is, of course, bleak. They point to the slowing disinflation. That's important. High public debt, highly leveraged governments, geopolitical and trade tensions, market volatility, and, of course, climate shocks as well. On the domestic economy, the objectives are a little more glowing than one would have expected. High optimism because of, recovering consumption, continued capex push by the government, strong bank and corporate balance sheets, easing liquidity, financial conditions, a resilient services sector. What they're not pointing out is that rural has done very well, not urban consumption so much. Government capex is very good, private capex is not so good, but those nuances are not there. The one conclusion the bond market can draw is, therefore, will they not cut too much? Are there only 2 more rate cuts, not 3, as some were expecting? That it leads to that kind of a doubt because the optimism stands out.
Latha, many thanks for joining us.